Money Radio for a really great future. We're talking real money.
As a regular listener to Talking Real Money, you know that we have certain basic beliefs, firm, sound, basic beliefs based on academic research, based on logic, sometimes even based on that silly little thing called common sense. Yes, indeed we do. And some of the things are, for example, when you're investing, you probably need to have a plan. You should diversify your investments. You should pay as little as you can. You should seek out people who aren't trying to sell you things, but are truly, honestly trying to help you and act in your best interest. But one of the most powerful tenets of our program is the following. You can't predict the future. You can't predict it. And most of us think we can predict it in a positive way. But some of us believe we can predict it in a negative fashion, that we can tell you which investments you should never consider buying, even if in jest we say, oh, you could always invest in the 99-year Argentinian bond, Tom.
The joke is now gone. The joke is on me. The egg is on my. I feel badly for the people of Argentina. You know, that I've been mocking them for the last 8 years, and it turned out that I should have been mocking U.S. Treasuries. What are we talking about? Well, it's a fascinating turn of events. Yes,
we're talking literally about the 2,117 bond. This bond matures in the year 2117.
Yep, 100-year Argentinian bond. That I think the yield is 7.9%. It's pretty good yield there. But okay, I got to ask you. I got to turn this around a little bit because the article talks about this bond issue versus U.S. Treasuries, which would have made more. So you might be surprised by the result. But did you know there's another country that issued a 100-year bond in the same year?
In the same year.
We didn't rehearse any of this, folks.
No, we did not.
I know.
We did not. That would be the Austrian bond, right?
That's exactly right. So if you were going to put money in A, U.S. Treasuries, B, Argentina's 100-year bond, or C, Austria's 100-year bond, you'd probably pick, for safety purposes, U.S. Treasuries.
Well, yeah, and between Argentina and Austria, you would probably pick Austria.
Yeah, kind of
which would have been a mistake.
Yes, because their bond is down by, I think it's about 75%.
It's about 80%.
Yeah, about 80%.
Yeah, about 80%. U.S. Treasuries were the total return, and we're talking about total return since 2019.
Yeah, that's
okay.
Right.
We need to give you our number, and the total return since 2019 includes a very bad time for all bonds.
Yeah, not an easy period of time there in 2022.
Right. So they all took a big hit there.
Yep.
But what is ironic is the fact that this 100-year Argentina bond really it nearly collapsed.
Yeah, 2020.
It
went right out of the gate.
Collapsed.
Yep.
It dropped
straight down.
And then they restructured the bonds after they literally defaulted on them.
Yeah, they did after 3 years, right out of the gate. What you would have expected, right? I mean, because
which is what Tom was saying, basically in his jesting way. I know. Buy the Argentina bond, and you will probably lose all your money.
Yeah, good chance.
But you didn't.
I know. Because one of the things that you just mentioned that we have a tendency to overlook is radical change, radical difference of the future than what we thought can have a large impact. Now, Javier Milei, I hope I'm not mispronouncing his name because
I've never been to Argentina, so I really didn't pay that much attention to pronunciations. I'm hoping you're right.
His nickname is El Loco, I guess, because of the spending cuts, the crazy stuff he's doing to the government there to try to clean up the balance sheet. So he came in, he turned things around, and guess what? This bond now is, as you correctly point out, in total return, still better than the U.S. Treasuries in the same period of time.
Since 2019.
Just 2019. So,
and I got to tell you, the dude has a head of hair on him.
Yeah, he does have a nice.
He does. I mean,
I'd
he's
like to
got
grow mine out like that.
He's got the President Van Buren sideburns.
He's got the whole thing going.
He's got the Trump hair, but it's black.
big hair. But what are a few takeaways from this? Well, first of all, the article points out correctly when the risks are obvious, they are often well rewarded. The risk here was very high. You got to know because they've done this before. They've had all kinds of monetary and fiscal problems over the last decades. And when they issued this, yes, it was laughable. Honestly, it was in the industry. People said, "Do not do that." Number two, for me, Don, the purpose of fixed income in your portfolio, right? I mean, why do you own bonds? Are you trying to make money?
For the big returns of them?
For the big returns, for just getting your money back. No, we're going to tell you should own bonds for the stability, for the fact that especially when you're taking money out of your portfolio, you're going to be able to draw from a stable base while the stocks may be moving around.
This certainly proves that they're not stable. This is a very volatile issue. And in 100 years, you're going to have incredible, even if it's a high-quality bond, even if it's a U.S. government bond that goes out 100 years, you're going to have extraordinary volatility due to interest rate fluctuations.
Yeah. I mean, you go back to 2022. I looked this up. The VUSTX long-term treasury fund at Vanguard lost 30% of its value. That's U.S. Treasury. I mean, that's long.
That is
loss.
A stock. And we've said this, and it's funny, we've said this for like decades in our classes that we used to do. We've said that a long-term treasury could be close to the volatility of stocks. And that 30% number bears that out. It was something we had never seen before. So people poo-pooed it. Oh, well, we're never going to lose that kind of money in long-term treasuries. Poo-poo, poo-poo. Well, look at what happened. It came true.
Yeah, I looked at our bond portfolio yesterday, and while we hold international bonds, we do not hold this bond. Sorry to say. So
really hard to believe that we didn't. Yeah, I'm thinking that Appella does not invest in long-term bonds.
No, number one. And number two, I think you could safely categorize this as junk, right? I mean, this is junky, right?
It was junk.
I know.
Mean, really, truly junk prior to the government restructuring. But we know how this goes in emerging markets countries.
Thank you.
That they'll go through periods of frugality and then they'll become spendthrifts again. So.
Yeah. And you get a volatility that goes with that, right? The ups and downs. And as we mentioned, Austria issued the same thing. It's now, you said 80% value. I saw 67% value yesterday, but it has a much lower yield.
The chart I'm looking at was from a while ago.
So, but again, this is risk I would not take. It is interesting that people that took it are getting paid for it. Now, here's a question to you. How's this all going to look in 25 years?
Well, I mean,
nobody knows.
But here's the point. We don't know. We don't know how it's going to look. But here's the point in issuing these. And I think the U.S. government should probably just go ahead and refinance its entire debt to a 100-year bond.
Well, there is discussion about lengthening out. Yep.
The reason being, none of us will care then.
That's true. Only
not one of us.
Only the people I saw at Arlington National Cemetery.
One of us.
Yeah, they're going to be
is going to care in 2025 what happened to the debt. Sorry, we're not going to care.
Yeah. So fair enough. So lessons learned again. You took risk. You got paid. Congratulations. Change, pretty hard to predict. Future, very hard to know what that's going to look like. And again, for me, fixed income should be fixed income, not variable perhaps payment. No way. I wouldn't do it.
And let me add something on that Austria bond, because I forgot to mention this. The Austria bond is even more brilliant, if you don't mind screwing future generations, in that it doesn't even have debt service.
It does not. Okay.
It's a zero coupon bond.
You got to wait a while to get your...
So you have to wait 100 years.
Woo. For
you to get face value back from the bond because you bought it at a huge discount to face value.
Yeah, exactly. So
wowzers. That is brilliant future planning.
It is.
Yeah. So I am just going to spend, I'm going to become a billionaire borrowing right now. I'm going to borrow a 100-year paper, and it's going to be all obligations of my grandchildren and great-grandchildren and great-great-grandchildren.
They're going to love you for that,
They're going
right?
to love me for that. But Grandpa, great-grandpa, he enjoyed it. Thank you all.
It was fun while it lasted.
What is wrong with us
So,
as a species?
Javier, congratulations on turning this all around, but we'll check in with you a little later to see how it's going. So.
And let's see if Tom can figure out a way to fit the Argentine bond joke back into the show.
I'll keep saying it, and people will be like, yeah, that's crazy. And then I'll have to say, well, it sounded crazy.
Then I think you need a new one.
I know.
Sometimes I know that new material, that anything new is not your thing. You're sort of opposed to newness. Change is not something you like.
No.
But every once in a while, even bad comedians need to change their material.
Deep rut, and you see me down in it.
Get out of the rut, dude.
I'm trying to change.
Maybe we have some funny questions.
No,
Odds
we don't.
Are good we don't. Yeah.
No, but
do we ever get a funny question?
We do have compliment on our humor, but we'll take that up in a moment. All right. Great. A lot of questions. Keep them coming,
by the way, they come in from talkingrealmoney.com on the contact form.
Love it. Dennis from Anaheim, California. I believe that's the home of Disneyland. Still my favorite Disney location.
Only because it's a whole lot shorter flight.
Well, that's true. It says, I'm a podcast listener turning 73 this month, continuing to work full-time for Disneyland as long as I can.
I love that. So many partially retired, semi-retired people work for Disney. There are tons of them when you go to the park.
The thing is, I wouldn't do that because it's a Mickey Mouse organization. So there's no way I would do that, but that's just me.
Once again, ladies and gentlemen, repeat after me. New humor.
Let's see. Says Dennis, I have an orphan 403B from an employer I left in 1997. That's going back a few years. managed by Lincoln Financial Group.
Oh gosh,
not one of our favorite. Seated with $4,000 from me and $70,000 from a defined plan payout. I set it and left it alone, and it has a balance of $316,000 in 4 funds, equally rebalanced quarterly. Hey, that's kind of nice. Now here's the catch. If there's still time before the 73-year-old deadline to avoid RMDs, what should I do? Are 403 RMDs delayed like 401ks if you're still working? Do I have a Fidelity Investments managed 401k Disney hourly savings? Roll it over. In other words, can you take the old plan, move it to the new one, and then not have to take RMDs? Or if you have an orphaned 403b, can you leave that there and not have to take the RMDs out of it? I want to mention a couple things because he was worried about the deadline of his birthday. First of all, with a required minimum distribution, you'll have to take it in the year you turn 73. So you got more time. It's not the actual birth date. So that's one thing. Number two, I don't know. You're going to look this up, aren't you, Don? Because you do this better on the fly. If you have an old 403B that's left out there, I think you're going to have to start withdrawing from it. I believe the only one you wouldn't have to is one you're still contributing to.
Yeah, that's correct. If you've reached the RMD age, you can delay taking RMDs from an employer-sponsored retirement plan. Here's the kicker. As long as you still work for the employer sponsoring the plan.
Yeah. So
which is absolutely, no, you cannot. That 403B.
It's got to start taking the money out.
However, if you move it into Disney's 401k,
then you wouldn't have to. Yeah. And you can still do that. You just turned 73 right now, so you still got time to do it.
Yeah.
And guess what? There's even more good news. You can continue whistling while you work because, that goes with the...
Yeah, I know. You just saw the movie.
I love the movie. Wow. I love it.
You didn't love the...
I didn't love it. And I was awake for 2/3 of it, which is really good for me.
Which 2/3, though?
I can't remember.
Was it the... Did they actually whistle in there?
Oh, yeah.
Okay.
Yeah.
Oh, that's good.
Marching off to work.
So they did keep that from the old.
They kept that. I'm trying to remember the lyrics after they say whistle while you work.
It's whistle while you work.
Then I know what's the next line. I couldn't remember.
Well,
I still don't remember. I know.
Whistle while you
I know.
work. I have no clue.
We turned it into something that wasn't that when I was a young person. Let's just put it that way. So thank you for your guidance. We've not been able, this is he and his wife, have not been able to agree on obtaining an advisor. So that's good. Well,
it's probably it's very likely because there's somebody who's got like that somebody likes that they want to work with. Here. Okay. All right. You ready?
Yeah, I'm ready for the next line because I've been wondering about this since I saw the film.
Have you?
I have. Right. I just one of those things you never quite get to look up the lyrics.
Okay, it really goes, whistle while you work,
yes.
And then they whistle, and cheerfully together we can tidy up the place, so hum a merry tune. It won't take long when there's a song to help you set the piece.
That's what
and then the next one is, and as you sweep the room, imagine that the broom is someone that you love, and soon you'll find you're dancing to the tune. When hearts are high, the time will fly.
Oh,
so whistle while you work.
All right. Not as good as I was hoping. So that's probably why I don't remember it. Now I'm going to forget it. Okay. Darren writes us from DeSoto, Missouri. Hi, Tom and Don. Dave Ramsey has a 4-fund strategy he recommends. Would you please compare it to Paul Merriman's?
What?
Are they similar? I love your show. Let me finish here. Totally dig your brand of humor. Keep them coming, he says. Thank you so much, Darren. Because, as you know, I don't get that a lot, and I take any praise I can get, which is scant.
I'm brutally honest with you. I'm sorry.
And probably important.
Oh, okay. Yeah, I remember Dave's 4-fund thing. It's not 4 funds.
Okay, I didn't know what it was.
It's not 4 actual funds. It's 4 types of funds, and it's really
active,
I remember
super active, really active.
I remember hearing it on a show, and I went, "What?
What are the 4
One, they're not
of
really
funds?
asset classes, and you can tell where he got these categories. He got them, again, from the American funds.
Oh, shocker there.
Because they categorize their funds as growth and income, aggressive growth, and international.
Okay,
so which 4 groups do you think he wants you to buy?
I hate those because those are meaningless to most people.
They're totally meaningless.
Growth, anyway, I don't know.
Okay, growth is stocks that tend not to pay dividends.
Yes.
Growth and income are stocks that pay dividends.
Yeah.
Aggressive growth are generally smaller mid-caps.
Terminology.
It's very 1980s.
Yeah,
it's the kind of terminology we used when I was a broker.
Yep.
Get an equity income fund, get a growth fund, get an aggressive growth fund, get an international fund. And, of course, you never tell anybody to buy bonds because bonds are a stupid idea.
Yeah. They don't make money.
They don't make money.
Unless you're in Argentina.
Unless, of course, when we were selling, get this, we were told, we were forced, I'm serious, we were told that we must sell the brand new Dean Witter Government Income Plus Fund.
Oh, that was one of the first pluses. You always got to get the plus.
Had a plus. And if I remember correctly, and this is my memory going back
40
a long time,
years? Yeah.
40 years. The yield when we were selling it was right around 13%.
What? 13%?
Yeah.
Gosh, I wish I had that for 100 years.
Yeah. And by the way, here's the other little kicker: is it was one of the first no front load funds.
Oh, yeah.
Did you hear the word I threw in the middle there? No, you didn't hear that because I whispered it. It was the liar load funds, as Christopher Cox, who was the chairman of the SEC at the time, called it, liar load.
Yeah.
We told people they were no load if we said it with our mouth. And then we handed them a prospectus that said, well, okay, there's no upfront fee, but you're going to pay an extra 1% every year for the rest of your life.
All right, Darren, to your question. No, they are not similar.
No.
Paul's would be asset classes, right? Not types of management.
They're not even vaguely similar.
Yeah, they're not at all. So, and so Dave gives those free? Like, here's how to build the portfolio?
No, he doesn't give you funds.
Oh, okay. Because Paul, you can go to his website and get the free portfolios.
No. Dave doesn't give you funds because Dave wants you to go to one of his trusted financial advisors.
Yes.
And if he gave you the funds, then you wouldn't need to go to one of his trusted financial advisors. You could go to anybody and buy them. Yeah. He doesn't want that because that doesn't make him any money.
Sounds a tad selfish.
It's
actually.
You think?
Just a little bit. Oh, you got to keep the lights on at the place in Tennessee. I get it. So anyway, no, they're not similar. Thank you for the kind acknowledgement of the brand of humor. And yes, I would go to Paul's first. So.
Humor. We're stretching.
I know. Well, he said it. I didn't say it.
I know. No, you didn't say it. It's unless, of course, you're lying about what's on that paper.
Yeah, well, that's actually on there. I didn't make that up. So that's it. That's all I got today. So sorry. I hope it didn't leave you waiting for more. But you know what?
No,
There's
no.
always tomorrow. So
No, there's always tomorrow. Tomorrow. I'll love you tomorrow. Oh, I'm going to run this idea past you.
Uh-oh.
Yeah, I've never told you this.
no. Yeah.
And I'm going to run it by you and the listeners and see if there's any interest.
Okay.
See if there's any interest. Because you sent me a note the other day that said, "Where is Money 30?"
Yeah.
Now, for those of you who
because
don't
somebody
know,
wrote us and asked us.
Yeah. Money 30 was a podcast I did in the year of my 30th anniversary as a financial talk show
I guess
host.
I'd forgotten that. These are shorter, like little pods.
Yeah,
right?
they were little short things, and I did them I did like 30 of them maybe.
Ooh, 30 makes sense. Sure.
I called it Money 30 because I've been talking about money for 30 years. So I put it up as a podcast back in the day. It was started in 2018, which was the 30th anniversary of me going on Business Radio Network. I did a bunch of them, and
they're still up there somewhere, right?
No, they're not. I took them down because we got rid of the Money 30 site when we merged with Appella. So we got rid of that. So they're down, but I still have all of the audio. So I was going back through them, and I went, well, there are some really interesting topics here. So what I was thinking is every once in a while, just for fun, dropping a bonus weekend podcast that was 2 or 3 of these turned into a 3-act podcast, much like This American Life, except with only Don speaking about money topics.
So I'm just going to go out on a limb and just say no. I think that's a bad idea, since that's what you're asking.
You think it's a bad idea?
Yeah, I do.
All right.
Because I'm not on it. I mean, it's not my funds. It's not my deal. So I'm going to. No, I think it'd be great.
Happier? Would you be happier if I gave you?
I don't want. I was teasing you. I don't want to.
At the end of it, you could just that was
much.
Okay, Don. That was stupid.
No, because we are in Financial Literacy Month, so this is a good time to restart that. And yeah, absolutely. Why not?
Is April Financial Literacy
It is.
Month?
Yes, it is.
I did not know that.
Well, there you go.
I thought it was Taco Tuesday month.
That's a lot of tacos. So no, I think it'd be great. Now, you of course have to go through the compliance, fun and games.
But I can send it to them.
Yeah, no, I think it'd be great. So sure, let's do it. Why not? And then those people that like to walk their dog on Saturday and don't have a podcast to listen to, now they're going to have a way to listen. So that's good.
All right.
Yep.
All right.
Yep.
No, let's see. It's I'm sorry, it's Stress Awareness Month too, so I don't want to do I don't want to give anybody any additional.
I want to be unaware of my stress.
Maybe I should put a jazz song in it because it's Jazz Appreciation Month.
Good Lord. Yeah.
Did you know that?
No.
See? Let's see what else it's what is happening.
I can tell you what it is for me. It's Find the Sun Again month, so I'm looking forward to it.
National Gardening Month.
I'll be planting my my garden in April. Yeah.
All right. See, there you go.
Yep.
All right. Hey, if you want to ask us questions, go to talkingrealmoney.com, click on the contact form, speak them or type them. If you want to talk with us live, call us on Saturdays when we do a radio show in Seattle. That number is 855-935-TALK. The time to call, 3 p.m. until 5 p.m. Eastern time. And if you really want to spend some time talking to somebody, set up an appointment with one of our advisors.
Yeah.
I know.
You can even talk to me.
It sounds like a sales pitch. It's not.
Yeah. I'll tell you a couple of bad jokes and try and give you some advice. That's the way it works.
Just go to talkingrealmoney.com and click Meet an Advisor. So look at all the ways you can get your life improved financially.
Yeah, well, it is Financial Literacy Month, so get smart.
And then get stupid in May when it's Financial Illiteracy Month.
Unlearn everything.
Unlearn everything you learned in May. Because you're going to forget it if you don't practice it.
That's
kind of like me in my video editing. I haven't video edited in such a long time that I had forgotten how to use Final Cut Pro.
Ooh.
So now I'm having to retake a course because I like learning.
Yes, you do.
Here I go, tangential again.
Please.
Recently read an article in the Wall Street Journal. It was a couple weeks ago. I think it was the Journal. Could have been the Post. I don't know. I read so many papers about retiring and what it does to your brain. That when you completely retire, unless you find something that is very similar to work in terms of interaction and learning and reacting to new things and all the things you do at work and socializing and all of that stuff, if you don't do that, there's an almost immediate drop-off in cognitive capacity. It's really fast. So use it or lose it is what they said. Another little retirement tip from Talking Real Money.
And here's another one. Ready? Do it together.
Okay, now thank goodness he's off key slightly, because if he was on key, that would be a copyright violation.
Oh, God, I don't want to go there. They'll come down on
But considering the fact that he messed up several of the notes, it could just be a parody.
Better yet than it should
which
be.
falls under, which by the way, YouTube, that falls under fair use.
I'm not going there.
Please do not yank the thing because he whistled while he worked.
It's a promotion. I was trying to help them.
It was whistling while you're getting out of a show. That was pretty much it.
Fair.
All
right. Thank you for joining us.
Oh, I forgot to mention. Later on, come over and listen to another podcast, and I'm pretty sure we're going to be talking real money.
The opinions and views expressed on this podcast were current on the date recorded.
Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appellate Wealth. The views and strategies described may not be suitable for everyone.
This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction.
Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appellate Wealth, a fee-only registered investment advisor.
Please see Appellate Wealth's ADV Part 2A on our website for information regarding Appellate's fees and services.
Appellate Capital, LLC, DBA Appellate Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appellate does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.